Welcome, everyone. My name is Brendan McCarty. I am CIO of Colony Management, and I welcome you back to our latest video. Today, we will share 5 quick charts that we found interesting from the past week into yesterday. First off, just to get you more information, if you want to learn more about Colony, please visit colony.com. If you want more information on us, email me at brendan@colony.com. Now, our first chart of the week starts with the airlines. I've been on social media. I've been writing about the airlines over the last few weeks, several weeks actually, because as crude has bounced, I wondered when the airlines would, sell off. Rising energy is not always the best thing for airlines, especially if they're not hedged or prepared for it. This latest rise argues that they were not prepared for it. But there is a seasonality to airlines at this time of year, which could explain your run up into the summer where everybody travels. Late summer, nobody's traveling, getting ready for school. So that could be what's pressuring the airlines. So the next big thing to watch on this is the chart. The 65-week moving average is 66.60. If the XAL bounces off that, it could argue a much sizable run higher, even with higher energy prices. The 66 level will probably determine what comes for the fall going forward for airlines. So we're watching it very closely. It also could give us an idea of what consumer travel looks like into the fall season. Second chart is Midcap 400. We talked about the NASDAQ and the S&P so much, so let's talk about the Midcap this week. First off, it has reversed double top of sorts over 2750, 2700. This reversal lower is following the Dow to some extent. The charts are very similar, but the Dow didn't run into any range resistance like the Midcap did. The Midcap failure at 2700 does follow parallels of the past where the index was overbought. Most notably in this case, 2016, and it traded back to the 65-week. You can see the 65-week is rather flat on the chart, which could argue the Midcap gives back a sizable amount of the gains over the past 8 weeks. Remains to be seen given what the other indexes could do, but the Midcap was late to the party, and those who are late to the party tend to sell first because they're seeing the biggest losses, and they run for the hills more aggressively when the markets sink. Third chart is gold. We should rename gold 2000 because gold can't seem to break through it. It rallied to it once again this past week and failed, as you can see, moving below resistance, moving right to the support actually in 1975. What comes next will be very interesting. If it bounces from this level and goes back over up to 2025 and confirms inflation pressure that we saw up until the last few weeks in the input side of the commodity markets, it could be breaking out. However, this resistance this week argues that perhaps the weakness across the sector, probably driven by CTAs trying to protect profits into month end July, is raising a red flag, saying, all right, inflation may not be rising, which is contrary to what we believe, but it'll all come down to what comes next in a way. Gold has been a very bad proxy for inflation. It did rise from 2015 into 2023, which was an inflationary period. But it hasn't really done much, as you can see, since 2020. It's risen to 2025 3 times and failed each time. Long story short, we're watching what comes next from this area. Failure here goes down to 1900. Bounce from here argues 2025 and maybe even higher. We're watching it closely. There is some vulnerability, however, in silver and the industrial metals, which both ran into resistance. Silver particularly fell hard this week. That's something to watch going forward as well. Fourth chart is our market risk model. We call it the ERT model. This is starting to rise more parabolically in a parabolic fashion, as you can see. It's also running up right against the band. This has happened prior, notably to the left of the chart off the pandemic lows. But we sort of take away that period and consider all this because we've never seen the ERT rise as quickly as it did during that time. When you put $4 trillion into money into the system, you will get people running for risk, taking more and more risk. They got more and more money. In this case, with the ERT going parabolic, we looked at 3 different scenarios previously. 2019 into 2020. We believe the market would have sold off anyway if the pandemic had arrived or not. If it had sold off and not got injections of money, we could be looking at sort of like the bottom of the bear market last year, but that never happened. Early 2016 was also somewhat of an area top we thought was going to happen previously, but tax reform changed that, and earnings risk rose. That led to a sell-off into 17 and a return to the 20-week. Finally, 2012, parabolic rise, more of a mediocre market, not the same type, but it rose, and in each case, the S&P is backtracked to the 20-week moving average. In this case, currently it resides at 4,300. Last chart is the S&P. As we title it here, we are downgrading the S&P in our charts. We moved to a short-term negative or bearish trend on the S&P. That failure is from the range you can see here. We've been largely bullish for much of the year, for good reason. More as it crossed over the 65-week, it's been rallying since March. NASDAQ faces a very similar chart, and we just showed you the mid-cap. We think at first, as a part of the ERT on the previous chart, this thing will migrate back to the 4,300 level. And then from there, we'll figure out what comes next. Traders have been following the Bollinger Bands and the mid-level quite closely on many different time frames this past year or the last few years, as people are following simple technical analysis to ride markets. It would be quite interesting the effect if it were to lose 4,300 and how quickly it would fall to the 65-week. But with that said, we're downgrading it to short-term negative, short-term bearish, along with the NASDAQ short-term bearish, as well as the mid-cap. Well, thank you very much for joining us today. My name is Brendan McCarty. I am, again, CIO and founder of Column E, and I thank you for joining us, and have a good rest of your weekend.